Hi everyone. In this project, we worked on a real-world optimization problem called portfolio optimization. In investing, one of the main challenges is deciding how to allocate money across different assets. If we invest too much in one asset, the risk becomes very high. But if we diversify properly, we can reduce risk while still maintaining good returns. Although we use global assist in this project, the same approach can also be applied to markets like the Colombo Stock Exchange. Here, we use exact optimization methods and heuristic method. First, we define our assets list, including major tech companies like Apple, Microsoft, Amazon, and also Bitcoin. Then we use the Y-Finance library to download historical price data from 2021 to present. This ensures that our analysis is based on real-world financial data, and financial data often contains missing values due to market clauses. To handle this, we use forward filling, which replaces missing values with the previous available price here. After that, we remove any remaining missing values to ensure the data set is clean. And finally, we save data set for like CSV file to CSV file here. And these are the results of that implementation. And next, we visualize the assets price using the logarithmic scale. This is important because different assets have very different price ranges, and the log scale allows us to compare their growth more fairly. Here you can see that graph. And when we calculate daily returns, then we calculate daily returns because optimization is based on returns rather than raw prices. We also analyze correlations between assets using heat map. Lower correlation means better diversification. Because the assets do not move in the same way. For example, here Bitcoin shows lower correlation with stocks, which help reduce overall portfolio risk. This is BTC USD, you can see here. And then next, we define our optimization model. The main objective is to minimize risk while ensuring the minimum return. The decision variables are the weights assigned to each asset. Here, we used our constraints as the total weights must sum to 1 and return must meet the target value. And short selling is not allowed. Those are our main constraints. And also we convert the annual target return into a daily value to match the scale of the data. To solve this problem, we use exact method called SLSQP. Which is gradient-based optimization algorithm that can handle constraints. First, we compute the average returns and the covariance metrics, which represent expected return and risk. Then we define the objective function to minimize portfolio variance. Next, we add constraint for the full investment and minimum return, and also set bounds between 0 and 1. it starts with equal weights and gradually adjust them to minimize risk while satisfying all constraints. Since this is a convex problem, the algorithm can efficiently find a global optimum. And here, these are the results. I'll change this target return to 0.15 and save. Then I run all. Then you can see here allocation percentage, I mean weights are same. Then I change this target return to 0.18 and save. And run, click run all. Now the results now shows different weights across assessed instead of equal allocation. This means the optimizer is selecting assets based on their risk return characteristics. For example, assets like Google and Amazon receive higher weights, while others receive lower allocations. This happens because we increase the target return, which forces the model to prioritize better performing assets, and this result is expected based on the model and the chosen constraints. It also shows that optimization results are highly sensitive to constraint selection, and by adjusting the target return, we move from a simple equal allocation to more realistic and meaningful portfolio. So now I will hand over to my teammate to explain the genetic algorithm and the comparison of the results. Thank you.
Thank you, Chaya. I'm Divesha. Now I will explain the second approach, which is genetic algorithm, and then compare the results. As we saw earlier, the exact method produces a structured solution. However, we also want a more flexible approach that can explore a wide range of possible portfolio. That's why we use the genetic algorithm. It works well for complex problem and does not require gradient information. The genetic algorithm is inspired by natural evolution. We start with random solutions and improve them step by step. In each iteration, we select better solutions, combine them, and introduce small random changes. Over time, the solutions improve. Here we define parameters such as population size, number of genetics, mutation rate. We also include a cardinality constraint which limits the number of assets in the portfolio. Next, we define the fitness function. We aim to maximize return while controlling risk. We also normalize weight to ensure they sum to 1. Additionally, we enforce the same minimum return constraint used in the exact method using penalty mechanism. This ensures that both methods solve the same optimization problem. And the algorithm starts with random portfolios. Then for each generation, it selects the best solution, applies crossover, applies mutation. This process is repeated multiple times to gradually improve the solutions. At the end, we select the best portfolio. This time, the allocation is more flexible and diverse. Different assets receive different weights based on their contribution to fitness function. In terms of performance, the exact methods achieves a slightly higher return. It's 16 percent, and the genetic algorithms achieves around 14.7%. The risk levels are similar. However, the exact method is very fast. The genetic algorithm takes more time due to iteration search, and from the comparison, um, exact method is fast, stable, and optimal. Genetic algorithm is flexible, diverse, and realistic. So observe a clear trade-off. Um, and this graph shows the runtime comparison between the two methods. We can see that the exact method is extremely fast, taking only a few milliseconds. In construct, the generic algorithm takes more time because it evaluates multiple candidate solutions over several iterations. This highlights the key trade-off between speed and flexibility in optimization methods. Um, when going to the key insight, this demonstrate as an important idea in optimization. There is always trade off between accuracy, flexibility, computational cost. Exact methods are better for structured problems, while heuristic methods are better for complex and realistic scenarios. This approach can also be applied to markers like the Columbus Stock Exchange to help investors make better allocation decisions. So, uh, overall, both methods are effective for solving the portfolio optimization problem. The exact methods provides fast and optimal solutions, and while the genetic algorithm offers more flexible and realistic allocations. So therefore, the choice of methods depends on the problem requirements. Thank you.